So, in this video, I'm going to be throwing a lot of information at you, but stick with me. Just save it, watch it a few times if you have to. Try and understand it because it is valuable information. So, the last 2-3 videos talked about the candles and how to read them, which is these fucking green and red things, and also the break at the trend video and how to spot where the market's going up or down. So far, that's all you need. Look at this on 1 hour time frame. You can spot the market coming down, and you spot the market about to start coming up. Same here, going all the way back. Oh no, that's the wrong thing. Put that away. You see the market coming up, see the market coming down, see the market coming up. That's all you need to know for now. Whereas today, I've been talking about this. What are we trading? It's the Nasdaq or the NAS 100, and it is literally just a collection of 100 companies that put their whole stock value into an index fund, and an index fund is literally just a collective of money put into a pool, and that gets put on a chart and we can trade it and make money from it. That easy. So there is a lot more behind it. Like if you look at the Google definition of it, stock market index made up of equity securities issued by 100 of the largest non-financial companies listed on the Nasdaq stock exchange. Sounds like a load of jargon, and it does make sense, but we ain't here for all of that. I'm here to make it as simple as possible for you so we can actually understand it. So today we're talking about lot sizes, contracts, pips and ticks. So the way you place a trade is through MetaTrader, which I'll put a little example of in the screen somewhere, and contracts, which you do through TradingView. There is loads of ways you can trade, but I primarily like to do it through TradingView. So you press buy or sell. If you think the market's going to go up, you press buy. If you think the market's going to go down, you press sell. But for instance, let's say we think the market's going to continue to go up here, so we press buy. We come to all of this shit. Now we can see how much we're risking per unit. A unit is a contract. It's the same thing. They like to change it here and there. Don't know why. It just is. Now, every 1 unit or 1 contract is how much money is risked on the chart. So pull the notes back up quickly now. If you look here, let's say every 1 lot is £1 risked per every tick. Now, what's a tick? That's good, we'll loop back to that. So if you come here onto the 1 minute chart, zoom it out, get going to that a sec. This is the 1 minute chart, right? You can see here at the numbers, it's currently on 23,559.75, right? Now it's gone on to 50.50. Now it's dropped the number down 75. So if you look here, we're on 95.0. Go up 1, 95, 25, 95, 50, 95, 75, 95 at 96. So every decimal is a tick, and every whole number is a pip. Tick and pips, different things, bit confusing, but try and understand it. So but decimal is a tick, and that is important to remember because every tick is worth $1. So if it goes up in ticks, every 4 ticks, which is a whole pip, is worth $4. So every pip is $4. Every tick is $1. So if we look here, no, wrong one. We go on to buy, and then we come down to here on the minis, which I'll explain in a minute. Every tick value is worth 0.5 US dollars, but let's just say it's worth 50p. So for every tick that it goes up, it's worth 50p. So every 0.25 is 50p. So 4 of them will be £2. So every pip we move is £4. So if we catch a move, let's say we enter here and we make the price, we enter in at 589 and then we get out at 609. So that's 30 pips. So we've made a 30 pip move there. So we do 2 times 30, £60 just from that move. Now this is on the minute time frame, right? Right there. So let's just say the stop loss was underneath this low. Just to get up to this high would be £60 just from that move. Now if we come out into the 15-minute, from all the action that's happened today, that move, that £60 is this big compared to the moves that you could get. That's just an example, and I hope you can understand where I'm going with it. So every decimal moved is a tick, and every whole number is a pip. And that's important to understand, because then we go to a different chart, because these are important to remember. Like I said, micro, the mini, sorry, is a smaller amount per tick. Whereas if I go over to the micro, sorry, the mini, so we were just on the micro. Now we go over to the mini and you press buy and you look down here, every tick value is now worth $5. So let's say £5. So instead of 50p, it's worth £5. Every decimal point moved is £5. So you move a whole pip, that's £20 made just from one pip. And bearing in mind, daily you're trying to catch 30 to 40 pips. But I don't personally like to count in pips. I just like to see where my targets are for the day and work out how much I'm going to risk and just see how much I can make to my target. So, fingers crossed, tick value is now sorted and you can understand how your money is placed. Now, risk management is also another thing. This is why I personally believe you can't make a lot of money with smaller accounts, because in order to make as many trades as possible, you want to risk as little as possible. So we'll write it here, yeah. If you have a £500 account, right, and this is just unanimous between everybody that trades, they all risk 1 to 3% of their account because that's a small amount. Theoretically, if you risk 1%, you'd have to blow 100 trades in a row before you blow your whole account. And you're not going to do that realistically. So you risk 1 to 2%. Well, 1%, 2% of £500, right? 1% of £500 is, let me get my maths right, £5. So you're risking £5, and let's say you want to make double that. So you're making a tenner. You're not going to be very, I mean, okay, cool. If you want to make a tenner every go and then double your account up, fair play. But if you could put that £500 into a funded account and then get access to 50 grand, you've now got a 50k account. 1% risk on that is £500. So now you're risking £500 per trade, doubling that. You're only making a 1 to 2. Now you're making, well, not, I went to a festival last week and it was a rough one. Boomtown was fucking amazing, but we'll not talk about that. We're here to learn fucking trading. In order to let you go to these type of events so you can live a free life. But 50k account, right? Risk 1%. That's £500, right? 1% equals 500, right? Now, you'll hear a lot of people talk about risk to reward, right? RR. If you're catching, it sounds weird when you say RR, but if you want to catch a 1 to 3, or 1 to 3, bloody hell, RR, what does that mean? That basically means for every 1 you risk, you make 3 back. So for every 500 we risk, we make 3 times that back, so we make £1,500. So all that means is 500 risked in order to make 1,500. Now it looks a bit better. Now you're making a lot more money just from simply going to prop firms and risking that. Now that's how you properly trade. You risk 1%. You could even risk 2. So from risking 2% there, so literally risk £1,000 to make £2,000. Now with prop firms, you pay 150. So you pay £30 for a 50k account, right? And then once you prove to the company that you can trade, they basically say to you, make 3% on the account. Which, well, can't remember the exact percentage, but the last 50k I tried, they said make £3,000 on the account, right? I made that within 2 weeks. Passed the challenge, and then that's you proving to them that you can trade. So they go, okay, cool, this kid knows how to trade. We'll reset your account back to 50k. Anything you make on top of this, you keep 80% of, we keep 20% of. So if you make £2,000 on it, they'll keep £400, you keep £1,600, and you've invested £150. So after you pay the £30, you pass the challenge and you make the £3,000. They ask you for an initiation fee. You pay the initiation fee, which is about £110, £120. So you're about £150 all in for the funded account, and then you make £2,000. You've now flipped a £150 investment into 1.6 grand using this formula here. So you might be thinking, well, how do I put that on the chart? So you find out your stop loss, and the way you do that is with your simple trends and your ideas. So if you think the market's going to go up, you want to target previous high. So let's say you even want to target this area right here. This is your previous area where price wants to go to. So you put your stop loss underneath the previous low, target the next high, boom, make money. You can, to be fair, with the units and contracts, whilst you're just learning, use 1 or 2. Just play around with it, because it is a little bit confusing at first, but when you can actually wrap your head around this and see how quickly, because this chart to me was very scary at first, because if it went the wrong direction, I was like £300-400 down straight away. Whereas if it went the right direction, I was making £300-400 like that. Whereas if you go on to the other chart, again, this is very easy to find. You literally just come up to the search bar here, type in NAS 100. Put this one on your charts first. One of these ones, any of these, doesn't really matter, because this, if you look, well, I've got it saved here. There we go. It will show you if I press buy. This is a trade I lost the other day, so I was using 20 contracts because the multiplier isn't as much. I use 1 contract, it's $0.1 US. So if you want to risk $1, you place 10 units. Oh, that's 9.45. 10. Now you're risking $1 per go, per tick. So every 1 tick, 4 pips. Every 4 ticks, 1 pip, and you're risking $4 per pip. So going with that and try to understand and just keep playing around with it, because the only thing you can do from this point forward is download that MetaTrader 5 in TradingView and just physically trade. You now know how to read what these red and green things are on your screen, and you now know how to place a trade, hopefully with 1 or 2 contracts. Now, what was my... Yeah, that's still on. Gotta make sure. Now, there is, you might be thinking as well, why have I got all these fucking grey boxes all around my screen, right? This is another little thing that is good to think about, and this is a prime example right now. Literally forming perfectly. So, price, let me remove this. Price rocketed up really quick and left an area, let me delete this, left an area that hasn't been touched. This is now an area of interest. It's called a fair value gap, right? Because there's I guess there's an unfair value here. Like shit pushed up way too quick, and now market needs to retrace and come down into that level to make a move up, because it's almost unnatural market, so it has to correct itself and come down in order for it to continue up. So what I like to do is draw out from the next candle, because it has to go from a fair value gap, comes in 3 candles. First one, the imbalance, and then the close. So I go from the close and the first candle across. Or sorry, from the wick of the first candle, because that's where price has been. So now we can see where price has come down to. It's touched just below 50% of the fair value gap, and now it's going to continue up. And I believe that it pretty much closed where the previous high was. So remember from the previous video, you literally look, broke the structure upwards, pushed all the way up, made a high, made a low, made a high. Now it's come down here and tapped into this fair value gap because the price came up to basically violently. It needs to correct itself. And now price is pushed up, made it equal high. Now if this makes a higher low, we can assume it's going to make a higher high and continue. And then if you targeted this high, like I said previous in the video, you've made money. it's that simple. And I know how to do it, so it sounds easy, but if you give yourself time to actually learn it, it can be this easy. I can literally just go on the markets, pick it out. Now, one thing that I would like to talk about in this video as well, and I will do a brief overview of it now and talk more about it in the next video, but is liquidity. Liquidity is a very, very big and vital part of the way I trade. So I go on a fresh chart, same chart, just without anything on it, and I go anywhere, right? Oh, that was a lot of trades that I'd done. Right. So remember in the first video, how I said you've got the body and the wick that comes up from the candle, right? Use this one as an example. So, price has been rallying up, but it broke structure, right? This area above here, people, you've got to think, right, as you've got to be almost like a flickering psychic. You've got to think about all the people around the world trading, right? Right now, they're going to be wanting to go to the previous high. Oh, well, this is during an uptrend, so they're trying to catch the next high. This is an all-time high. Price hadn't been to this point yet. So, pushed up, pushed up, pushed up, pushed up, come down. Now, what's happened here is price is pushed all the way up and took an invisible pool of money here called liquidity, right? And then it's come down, pushed up, faked people out and thinking that the uptrend is going to continue, and then plummeted down. This spike right here was the signal the market was going to push down, because people have things called stop losses. They have them if you're going down and you think market's going to go down, you usually put your stop loss above the previous high. So let's say you had some foresight in the market and you thought that the market was going to go down. What tends to happen is this spike will take you out of that trade, grab your stop loss and everybody else's that's in that trade, and then move down to, so that spike is the fuel it needs to push down in the market and then create a low. Now, again, it's close, but this spike right here was below all these lows. Now, if you're trying to go up and get an uptrend and get a long position out of this, you would put your stop loss underneath this low, because that's the previous safe area where price hasn't been to. Now what's happened is it's come down, taken out this one and this one, taken out the invisible pool of money here, and then binged right up. Now you can literally, if you look at all the big spikes, that usually tends to be where liquidity is. Now there is a lot of them and not all of them work, but when you're trading day to day, you can see how they form. And it's usually when you're trying to come through and backtest and look for them, you want to look for the spike before the trend. So this was the spike before the trend shot up. This was a spike, a very big spike before the uptrend, and it's continued to shoot up. Now bear in mind this is over hours and they fall under loads of time frames, and you can spot them pretty much anywhere throughout the market. So for instance, a big gap here from market open where price just said fuck off, opened, came all the way through this fair value gap but didn't close below it. It whipped below it to grab liquidity and then shot up. You could catch a trade from that. You can make money from that before it dips, before it reverses the other way. Again, trend went up, faked people out, grabbed liquidity, came back down. It happens over loads of time frames, and that took from Monday to pretty much Tuesday midday. So if you'd have thought, oh, it's going to go up and it's just grabbed liquidity on the Monday morning, which would have been here, so Monday afternoon, by the time you go to bed Monday, you're up money. And then if you left it on Tuesday, now you're up a considerable amount just from that, just from a liquidity sweep, a fair value gap, and that was it really. Liquidity sweep, that happened there, didn't go below the fair value gap, so we can assume that it's going to go up. Came above the little green candle, broke the structure, boom. You can, I know I'm cherry picking right now, but when you come through to the day, like right now, I would be safe to say that this is an imbalance. Well, first off, the big imbalance that's happened here, but if we drop into the 15-minute time frame and we go lower, we can now see that price has made a high, a low, a high, a low. Now, if it continues that and pushes up above these current sets of highs on the 15-minute time frame, we can assume on the 1 hour it's going to do the same thing and rally up to the previous highs. This is how you determine a bias and how you use them. I will make a separate video again on how to find liquidity, but for now, that is fair value gaps and liquidity and lot sizes. Like I said, there's been a lot that's come into this video, and I might even break it down into chunks, but this is important to understand. because this is how your money's moving. This is how you figure out how much money you want to risk. And that's the be all and end all of how to properly place a trade. And that's how you use some of the confluences. Again, what are confluences? They're the fair value gaps, the liquidity, the break of structure, the trend. They're all things that make you think that market's going to go one direction or the other. And we determine them and make money from that. That is pretty much the only way I can describe it.